Explainer, how Britain is exploiting Brexit to reform finance. Britain proposed over 30 reforms on Friday to bolster the City of London's role as a global financial centre, now outside the European Union and facing competition from Amsterdam, Paris and Frankfurt, as well as New York and Singapore. Is this a Big Bang 2.0? Well, not quite, but it marks a swing in the regulatory pendulum from years of increasing banking capital requirements and tightening consumer protections to thinking what tweaks are needed to make rules work better for Britain after Brexit. Initially trailed as a Big Bang 2.0 on the same scale as far-reaching 1980s reforms of share trading, the changes have now been dubbed the Edinburgh reforms, after the city where they were formally unveiled by Finance Minister Jeremy Hunt. The government has toned down its rhetoric, insisting there will be no race to the bottom, big departure from international norms, or scrapping investor protections, but that regulators should aid the financial sector's international competitiveness. Hunt said it would be wrong to call the reforms a big bang, given the need to avoid unlearning lessons from the 2008 global financial crisis, and underscored the independence of regulators. The city does not want to see deregulation. Today's announcements are an indication of an evolution rather than revolution, said Alasdair Haynes. He's a CEO of Aquis Stock Exchange.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
What's ring fencing all about? Well, Britain has already announced an easing of capital rules for insurers and is now turning to banks. Since January of 2019, banks have had to ring-fence their deposit-taking arms with a cushion of capital to insulate them against blow-ups in their riskier activities. Banks have complained the rules are too strict and hinder smaller ones from competing with the bigger lenders in the mortgage market. The government said it will follow recommendations from a review it commissioned and amend the rules. The government will consult mid-2023 on exempting banks without major investment banking activities from the rules and on raising the deposits threshold, which triggers compliance with ring-fencing rules from £25 billion to £35 billion. Are bankers now off the hook? It's not back to pre-financial crisis light touch. The government had already announced it will scrap an EU cap on banker bonuses, though other curbs on how bonuses are paid are expected to remain. Britain introduced rules in 2016 to make senior bankers, adding senior officials at insurers in 2018, directly accountable for the decisions they take after few individuals were punished for misconduct that led to the global financial crisis when taxpayers bailed out the lenders. It was feared as a tool to publicly shame bankers by putting heads on sticks, but so far there have been few investigations or enforcement cases. And bankers say regulators also take too long to give the green light to senior appointments. The government will review this senior managers and certification regime in the first quarter of 2023, with no indication yet of the scale of any changes. And green finance. Well, the government will consult on bringing environmental, social and governance, also known as ESG, company ratings providers under the regulatory net. The ratings are widely used by investors for picking companies which tout green credentials, but they are not regulated. And the Financial Conduct Authority said it would encourage regulation focused on transparency, good governance, management of conflicts of interest and robust systems and controls. Thanks so much for watching. Please do like, share, comment. Keep watching for more market insights and business news. Sage for Kalkine Media.